What I have for you today is an interesting case which leads to a collection of cases on profit allocation to PEs. Now, we don't often see cases on profit allocation to PEs, so I'm always happy when one comes around, and this one touches on something pretty fundamental. Let's have a look at UPS Asia Group Agency PE and its profit allocation. So the case starts, and we have a bit of an onion-like scenario. We had a case many years ago, Morgan Stanley, which addressed the question in this case the first time. It went all the way to Supreme Court, and that is law of the land. And after that, we had Audit versus Asia Today Limited, which I believe was a Mauritian news publisher with a PE in India. We had DDIT versus SET Satellite, where again the tax authorities claimed that there was a dependent agency PE. And then we have the UPS Asia Group Limited case. So let's have a look and see. The court in the UPS Asia Group says, in the present appeal, primarily two issues arise. One, whether or not the SSC has a business connection under Section 9.1 of the PERM Act and permanent establishment, in other words, also under the treaty. And two, how much of the profit can be attributed to the said business connection or the PE. And that is the real question that's being dealt with. A 10-second commercial. If you want to learn more about international taxation or transfer pricing, or treat yourself to an all-round update, or if you want your team to learn or stay updated, please visit my online courses. Now, if we look at what the court says in terms of the facts, the SSC is a company incorporated under the laws of Singapore, and it is engaged in business of provision of supply chain management, including the provision of freight forwarding and logistics. So it was basically a logistics company, as we know UPS to be. The SSC had entered into a regional transportation services agreement with the Indian associated enterprise, namely UPS SCS. Under the transportation agreement, the SSC arranged to perform international freight transportation and provide overseas support services, while the Indian associate entity performed freight and logistics services in India to its India customers and to the SSC. And this is quite a common setup in logistics groups, right? You have two logistics companies in two different countries, and they simply arrange, listen, if I get a container full of stuff that I need to send to your country, you will in your country pick it up, unpack it, and send it to the customer, and I will do the reverse for you. So these are not uncommon transactions. During the course of the assessment proceedings, the SSC was asked to explain as to why the Indian associate entity should not be treated as a business connection of the SSC under 9.1, in other words, a dependent agent. The assessing officer further held that the Indian associate entity of the SSC constitute a PE of the SSC in India within the meanings of Article 5 of the Singapore-India Treaty, and the assessing officer attributed an amount of profit to the PE in India, right? So the Indian tax authorities believed that the Indian company was a dependent agent for the Singapore company. And something similar happened in Audit versus Asia Today. If we look at the facts here, I must say that the facts here, the court quotes a number of different cases, but it quotes all of them in italics, and sometimes he quotes the quotes in italics as well. So it's not always easy to know to which case the court refers, but in any case, here is the text for Asia Today, I believe, which says the SSC before us is a foreign telecasting company incorporated in Mauritius and having a tax residence certificate of Mauritius. It sells advertising time and collects subscription revenues through its Indian affiliates Z Telefilms Limited and LZ. But its claim was that since it does not have any permanent establishment in India, no part of its income was taxable in India. The assessing officer was of the view that its Indian agent constitutes a virtual projection of the foreign company, and therefore it has a permanent establishment in India. And virtual projection means dependent agent, right? The assessing officer further observed that the SSC has an agency permanent establishment under Article 5.4 of the Mauritius Treaty, inasmuch as its Indian agents are the dependent agents. As for the plea of the SSC, no further profits can be attributed to the SSC as the agent has been paid at arm's length already. The assessing officer rejected the said plea. Okay. And then finally we get to the Morgan Stanley case, and this is where the Indian doctrine started and actually made its way all the way to the AOA, as we will see in a bit. And this is what the court said about Morgan Stanley. We may now consider the judgment in Morgan Stanley and Company, and then they quote and they say the issue involved Morgan Stanley and Company, for short MSCO, and that was the US company and one of the group companies of Morgan Stanley Advantages Services PVT Limited, short MSAS, which was in India. An agreement was entered into for providing certain support services to MSCO. MSCO outsourced some of its activities to MSAS. MSAS was set up to support the main office functions in equity and fixed income research, account reconciliation, and providing IT-enabled services such as back office operations, data processing, and a support center to MSCO. It was ruled that MSAS should be regarded as constituting a service PE under Article 521. On the second question, the advanced authority on rulings ruled that the transactional net margin method was the most appropriate method for determining the arm's length price in respect of which the services by MSAS should be taxed with MSCO. But it also said that no further income was attributable in the hands of MSAS in India. The said ruling of the AAR on the question of income attributable to the PE was the subject matter of the challenge by the department. Insofar as the issue of a PE is concerned, the Supreme Court was pleased to hold that it agreed with the ruling of the AAR. In other words, MSCO did have a dependent agent PE through MSAS, right? However, the court ruled that the important question which arises for the determining is whether the AAR is right in its ruling when it says that once the transfer pricing analysis is undertaken, there is no need to attribute profits to a PE. The court further reiterated that the main point for determination was whether the AAR was right in the ruling that as long as MSAS was remunerated for its services at arm's length, in other words, the Indian dependent agent, there should be no additional profits attributable to the applicant or to MSAS in India. And the argument makes sense from the point of view that, you know, that if the US company has no one else in India, then all the functions must be performed by the Indian company. And if the Indian company is compensated for all its functions at arm's length, then there's nothing left to tax in the PE. But there are different views about this, right? So the Supreme Court said, after discussing various issues, the court held as regards the attribution of further profits to the PE of MSCO, where the transaction between the two are held to be at arm's length, we hold that the ruling is correct, the AAR ruling, in principle, provided that associate enterprise, MSAS, is remunerated on an arm's length basis, taking into account all the risk-taking functions of the multinational enterprise. In such a case, nothing further would be left to attribute to the PE. The situation would be different if the transfer pricing analysis does not adequately reflect the functions performed and the risk assumed by the enterprise. In such a case, there would be a need to attribute profits to the PE for those functions risks that have not been considered. So in other words, if you pay your dependent agent at arm's length for everything he does, there is nothing left to be taxed in the PE. That is a nice, simple approach. It was also followed by DDT versus SAT satellite, where the court said it is important to note that the assessment officer concludes his relevant analysis by adding, in the case of other telecasting channels, also it is held by the revenue authorities that their agent in India constitute a permanent establishment. In other words, you have a 5-4 dependent agent. In the light, and the court goes on to say, in light of the Honorable Jurisdictional High Court's judgment in the case of SAT Satellite, and just for background, for SAT Satellite, the AAR first decided that SAT Satellite could be taxed in India because there was separate risks which could be allocated to SAT Satellite and taxed under the PE in spite of the dependent agent getting an arm's length compensation. But that decision was turned over by the High Court, in which the High Court says, so far as profit attribution of a dependent agent PE is concerned, the legal position, and this is referring to Morgan Stanley, I believe, is that as long as an agent is paid an arm's length remuneration for the services rendered, nothing survives for taxation in the hands of the dependent agency permanent establishment. Viewed thus, the existence of a dependent agency permanent establishment is wholly tax neutral. And here the court touches on a very fundamental issue that we will look at further, right? Because if it is true that when the dependent agent is compensated at arm's length, there's nothing left to tax in the PE, then what is the function of Article 5.5 of the Model Convention? Does it then mean that dependent agent PEs are only taxable in the PE state if the dependent agent itself wasn't compensated at arm's length? I mean, that is a lot of text and a lot of doctrine for something which basically is tax neutral, right? Or basically not taxable. And we will look at this further. And here comes the theory, the case of the revenue, and this is what the courts have discussed. Not in our UPS case, but the UPS case refers to this discussion that the courts have held before. And it says, the case of revenue is thus clearly confined to the existence of DAPE on the facts of this case. When there is a PE in the source jurisdiction, only so much of the profits of the foreign enterprise as are attributable to the PE can be taxed in the source jurisdiction under Article 7.1, right? One has to examine the tax implications of DAPE, and that tax implication is that the profits attributable to the DAPE are brought to tax in the source jurisdiction. So in other words, when you do a PE, the PE profit should be taxed. That is what Article 7.1 says, right? The next logical point has been a subject matter of academic debates and controversies. There are two approaches, and now we come to it. First, a single taxpayer or zero-sum approach, and second, two taxpayers and a non-zero-sum approach. While Philip Baker, here they say banker, they mean Baker, a well-known international tax lawyer, has all along advocated the zero-sum approach, late Klaus Vogel has given his approval for the two-taxpayer approach. The latter is also in consonance with the authorized OECD approach of the OECD from 2010. We'll have a look at that. On materially similar facts, in the case of DDIT versus SET satellite, a coordinate bench has upheld that the two-payer approach in computation of the DAPE profits, right? So that is what as I said, the AAR said. But then, and let's just have a look at what late Klaus Vogel said, referring to the above coordinated bench decision, had this to say: one can understand that many have problems imagining how profits should arise to a permanent establishment which does not exist in reality, right? Because remember, you don't have a fixed place of business, you just have a dependent agent, right? Such skeptics should consider, however, that the parent enterprise as a rule will aim to realize receipts from the contracts concluded by the dependent agent, which, in addition to compensating the agent's fee, include a surplus profit. And that is true. I mean, a principal would want to make more profit than what it just pays its dependent agent, right? And Vogel goes on to say, otherwise, the parent would lack any commercial reasoning for employing the agent. The surplus is attributable to the activities in the parent's residence country. Rather, sorry, I'm reading this wrong. Vogel said this surplus is not attributable to the activities in the parent country's residence. This is the heart of what we're talking about. Rather, it is a profit that the parent obtains through employing the agent. Fairness in the PE country. Fairness, in terms of an international equity, requires that the surplus profit be taxed in the PE state. If the drafters of a treaty or model treaty wanted to provide this, they must notionally attribute it to a contract in that state. This does not mean that they must attribute it to a person or an object in the real world. Okay, so they say the Vogel goes on with a fake agency, right? And he says, in the world of law, a legal concept, a figure of thought will do. So you don't need a real person. The agency PE is such a figure of thought. So Vogel himself says, we are taxing ghosts here, right? Because these things do not exist. Thus, it is not only possible, but it is the rule that a profit exceeding the agent's compensation will be submitted to the agent state. And this is the Vogel approach. Is also the OECD approach. It is not Baker's approach, as we'll see in a moment. I don't say this lightly because Vogel is a tax god, but I disagree with Vogel because at the end of the day, if you read the AOA, it is very clear that profits are attributed to significant people functions. In other words, there must be people, they must be doing something, what they're doing must be significant, and then you attribute profits to it, right? And if the dependent agent is the only people in the country and the dependent agent's people have already been compensated at an arm's length price, there is nothing left to be taxed. But this is not what Vogel said. And by the way, this is what got the OECD into trouble when they dealt with BEPS Action 7, and they followed this doctrine, right? And they said, that for commissionaires there is a dependent agency PE, and we will tax that. And they for more than a year, I think, went down the line of trying to create nexus or trying to say that there was a PE and arguing why there was a PE, even though there were no people, right? And they also tried to allocate profits to this PE. And it became impossible because if you can allocate profits to ghosts, then the taxation of PEs becomes wholly unpredictable, right? And that's why the OECD instead went for Pillar 1 and changed the wording and said you don't have a PE in the other state, you have nexus in the other state, and we tax you for the nexus, right? So it'll be very interesting if the AOA were to be rewritten to see what they would do. But anyway, this is what Vogel said. Against Vogel, another tax god, Philip Baker, said as follows. He did not agree with Vogel's approach. He has favored the other alternative to the issue, i.e. the single taxpayer approach. He observed that one view is that if the dependent agent is being remunerated on a correct arm's length price for the function he performs, risks he assumes, and assets he employs in his agency, there is no basis for attributing any further profits to the DAPE over a dependent agent oversee over and above the arm's length remuneration to the agent. And reasoned by the same, observing that as soon as one abandons the single taxpayer approach, one needs to start attributing to the DAPE functions that were not performed by the DAPE exactly, assets that were not employed by it, and risks that were not assumed by it, or more importantly, controlled by it. In other words, the two taxpayer approach requires an abandonment of reality, an entirely hypothetical attribution, which in arm's length world must have some basis in reality because you need significant people. And this is simply a license for arbitrary allocation of profits. Ultimately, that's what the tribunal did here, and he's referring to what the AAR said in the ASCT satellite case. And I'm completely with Philip Baker on this one. You cannot tax ghosts. You have to, if you're going to say that risks are allocated to a country, then you must have people in that country managing those risks and having the capability to bear those risks, right? Just read chapter 1D. And that applies to PEs as well. But the AOA, interestingly, says something different. In paragraph 235, the AOA, talking about dependent agency PEs, says, it is worth considering an alternative approach to the taxpayer approach, right? Put forward by some commentators, read Philip Baker, which contends that in all circumstances the payment of an arm's length reward to the dependent agent enterprise fully extinguishes the profits attributable to the agent PE. Since there are no other functions performed, assets used, and risks assumed in the host country, there can be no further profits to attribute. The functional and factual analysis may show that certain risks, for example, inventory and credit risk under a sales agency arrangement, belong not to the dependent agent enterprise, but to the non-resident enterprise, which is the principal, right? Because that's what the contracts, for instance, say. Because you have a commissionaire, for instance. Although it is agreed that the risks are legally borne by the non-resident enterprise, the difference between the two approaches is that under a single taxpayer approach, those risks can never be attributed to the dependent agency PE of the non-resident enterprise, which makes perfect sense because there's no one there to control those risks, right? Whilst, says the OECD, the authorized OECD approach would attribute those risks to the dependent agent PE for tax purposes if, and only if, the dependent agent performed significant people functions relevant to the assumption or subsequent management of those risks. And the OECD is just contradicting itself, because the dependent agent PE, whatever it did perform, it was compensated for already, right? While superficially attractive, the OECD says about the single taxpayer approach, in fact, it contains a number of fundamental flaws. Firstly, this approach would not result in a fair division of taxing rights, and this is Vogel, as you've seen, between host and home jurisdictions, as it ignores assets and risks that relate to the activity being carried on in the source jurisdiction, simply because those assets and risks legally belong to non-resident enterprise. And more importantly, there is no one left in the country to do them, right? Indeed, such an approach would go against one of the fundamental principles of the PE concept, which is to allow within certain limits the taxation of non-resident enterprises in respect of their activities in the source jurisdiction. But you've already taxed that. The single taxpayer approach simply does not consider that if the risks legally belong to the non-resident enterprise, it is nonetheless possible to attribute those risks to a PE. And what the OECD should have said here, if you wholly ignore Article 1, Chapter 1D of the Transfer Pricing Guidelines, and specifically the six steps for the allocation of risk, right? And the OECD then goes on and explain a number of reasons why they think that the one-step approach is wrong. I always think that if you need a number of arguments instead of one strong argument for your own argument, then maybe your own argument is not that strong. I want to touch on one more thing on an ASCT satellite. We've already seen what the court has said here, but they bring up another interesting point, and maybe there is room for the OECD approach in this. And they say, an interesting offshoot of this legal position is that the existence of a dependent agency PE permanent establishment is of no tax consequence, because there's nothing for the PE to be taxed, right, if the agent is taxed at arm's length. Such an approach may sound somewhat incongruous from an academic point of view. The very approach to the DIA, inasmuch as what was considered to be a threshold limit for source taxation, ceases to have any relevance for source taxation, because if you compensate at arm's length, there's nothing left in the PE to tax, so why even mention the PE? The very approach to the DAPE attribution, profit attribution, may seem incompatible with the underlying scheme of taxation of cross-border business profits under tax treaties. And then the court comes with an idea, and the court says in SCT Satellite, I believe, and says, in all fairness to the learned departmental representative, in other words the tax authorities, we may take refer to observations in another coordinate bench decision in the case of Delmas France versus Audit, to the effect, similarly, before accepting the dependent agency profit neutrality theory, we still have to deal with the learned department's plea in Morgan Stanley that the arm's length principal remuneration paid to a PE must take into account all the risk of the foreign enterprise as assumed by the PE. But then that court went on to say, but then in an agency PE situation, unlike a service PE situation, which was the case before the Honorable Supreme Court, and I think they refer to Morgan Stanley here, a DAPE assumes the entrepreneurship risk in respect of which the agent can never be compensated, right? Because an agent cannot assume the entrepreneurship risk. And this is exactly, the Indian court says exactly here what the OECD is getting wrong, right? To this extent, because I mean, it is true, the agent cannot assume the entrepreneurship risk, but he can also not control it for the principal, because there are no people in there to control it, because they've already been compensated at arm's length, right? To this extent, there may clearly be a subtle line of demarcation between the dependent agent and the dependent agency permanent establishment. The tax neutrality theory, on account of the existence of a DAPE, may not indeed be wholly unqualified, at least on a conceptual note. So in ST Satellite, they said, you know, Morgan Stanley Concerned Services, and there we get that if you compensate the agent on an arm's length basis, then there's nothing left to be taxed. But what about if you have a sales agent? You know, they only do their sales, but they are inventory risk and bad debt risk and currency risk and all those things, and shouldn't that be allocated to a PE? You know, there is logic in what is being said, in the sense that no principal would ever hire an agent and give all his profit to the agent. On the other hand, you have to allocate the profit and the risk to where it is controlled. And if it is controlled by the principal in the principal state, then it belongs to the principal in the principal state. If it is controlled by let's say the control of the risk is outsourced to the dependent agent, then the dependent agent should be compensated at arm's length. And then the question again remains, what else should you tax then in the dependent agency state, right? I think this is quite an interesting discussion. The court, however, also in this case, like they did in ST Satellite, said the issues have already been decided in tribunal in favor of the SEC and against the revenue for the preceding years. That was another interesting issue in this case, that UPS already won this case for, I think, 2012, 13, 14, and 15, and yet the tax authorities still came back with 15, 16 and said, no, you have a PE and there is taxable. We hold, the court, however, says that when an Indian associate enterprise is remunerated at arm's length, no further profit attribution is required. And the court is doing what it's supposed to do here, right? The court is not supposed to follow the OECD guidelines. The court is supposed to follow the Indian Supreme Court in what it says about cases like this. I hope you enjoyed this case. It was a little long, but it was actually many cases in one. And it touches a pretty fundamental issue in transfer pricing and in the taxation of PEs. And we can only follow future developments with interest. I look forward to seeing you next time. Bye for now.